Well, welcome to this week's edition of Cattle Call. I'm Susan Littlefield. Lots of rain throughout the Midwest. So, what is that going to mean for our feeder cattle market? And folks are itching to get back out. Does that mean that they're maybe going to restaurants, they're going out to hotels, taking mini vacations? All of this is going to have an effect on what we see within the cattle market. As you can see, Brad Kooima is on the screen. He is with Kooima and Varlick out of Sioux Center, Iowa. So let's start out. They say rain makes grain, but at this point, is rain making some good beef?
How about rain makes grass? That would be a good thing, right?
Yeah.
I think that's a bit of the market element here today. Now, if you're living in Lemon, South Dakota, you're probably not really feeling the love quite yet. But areas of the wheat pasture and sand hills and stuff like that, picking up some moisture. I think that's some of the influence here behind this feeder cattle trade. But you've got a higher deferred live cattle market here too, and the feeder cattle just had about a $6 sell off. So, but I'll take it. It's nice to get the big $3 up, and I do think some of it's because of pasture conditions improving with this moisture.
We also saw some decent bids already coming out midweek out of Nebraska.
For the first time in quite a while, this Fed cattle exchange, a lot of people have kind of disparaged it. I'm for anything that increases the number of negotiated cash trade. Of course, the Fed cattle exchange has been a bit of a slow starter. That would probably be the understatement here of the day. But today, actually a little bit of a market maker. They traded some pens of cattle out of Nebraska at 116. They traded a few pens of cattle in Texas at 115. And then since that, now the direct trade has been. I know that there's a number of 115 bids in the South that are getting passed. That's fully a dollar higher. There's been some meat bids up in the north at 184, which is 2 to 3 higher than what it was last week, maybe as much as 4. So finally, we've got a cash market that's catching fire just a little bit.
So does that mean that because cash is improving, business might be improving as well?
We got a packer that has got plenty of margin. I mean, who's kidding? The boxes are 236 or something like that, and I'm told going higher. The demand has been great, of course, and it continues to get even better. Warmer weather, hotel restaurant trade starting to develop here with more vaccinations, more herd immunity, more states coming open, more restaurants coming open. I'm told the boxes have a little more room to the upside. This would be the time of the year, of course, Susan, where you would expect the middle meats. That's the high price cuts, the ribeyes, the loin, the strip. They go higher anyway because the weather gets warmer, and they can, so they do charge more. So yes, and I think a little bit of an element is, for several weeks, it seemed like every packer was taking their turn at cooler cleanouts or repairs, scheduled repairs, yada yada. But we're just about through all of them, and so maybe with just a tick bigger kill capacity here, also the packer willing to spend a bit of their margins then.
What a difference a year makes when we think back to March of 2020 and where we were sitting in the uncertainty. It's nice to see this oncoming light isn't a train, and it might mean the daylight is in front of us.
Susan, I can't even. I it was hard to know how to react to something that never had happened before. I know I would be the first to admit that I think I underestimated the gravity of the situation at the beginning of the whole COVID thing. Although a year ago at this time, I know the market was terrified of what do you do without kill capacity, without an ability to slaughter cattle, and trying to figure out what you're going to do with this whole backlog. This is about when it started with 5 or 6, 7 weeks. I think I went 6 weeks without able to get a bid. I hope we don't have to live through that again. And as of last Thursday's slaughter data, basically for the first time in a year, the average steer and heifer carcass weights are equal to or the same as a year ago. So it's taken a long time to get that weight back off. The cost of gain is certainly part of that equation. I think that's why we're going to get lighter weights. It'll be interesting now. Some of the analysts like myself, this is kind of the last data week where you can have that year-on-year comparison and have it worthwhile. We're going to start comparing to no slaughter and all sorts of weird stuff. So I still believe that the supply of cattle in the north moving forward in the next 60 days is less than what it was and what most people think it is, and I continue to remain optimistic. So I hope we can get this market on top of break evens because we're not there yet. These cattle that are getting sold today still lose enough money.
Well, it'll make for some interesting marketings in the weeks ahead without that comparison.
For sure.
All right. Thanks, Brad, for joining us this week.
Welcome.
That's been Brad Kooima. He's with Kooima and Varlick. Just a quick reminder that commodity futures and options do involve substantial risk of loss and might not be suitable for all investors. That's this week's Cattle Call. I'm Susan Littlefield.